Eiad Asbahi runs the fund and is here with us to talk about the latest on a stock that I don't think a lot of people knew about, Eiad, before this report, but it's been getting slammed, and you say there's got more to go. It's Middleby Corp, MIDD. So walk me through it, Eiad.
Sure, and great to be with you again, Oliver. Middleby is actually a $3 billion customer, so it's a very well-known company in this space. In fact, it's one of the largest providers of industrial kitchen equipment to quick and full-service restaurants and retail outlets and hotels. Middleby is a debt-fueled roll-up. It's basically acquired its way into being one of the largest providers of industrial kitchen equipment. And we think that this debt-fueled roll-up strategy is set to implode. That's the core premise of our thesis.
How much is the debt playing a role here? Because if are they going to be able to get some help from the government? Have they getting any bailout money?
Well, it is huge, and I do want to talk about what the effects of what the bailout of the effects the bailout money is going to have on the industry that it sells its products into, and that's the restaurant business. People are going to be misincentivized, malincentivized to go back into work. The unemployment benefits under the CARES Act essentially make it to where any individual that earned less than $26.60 per hour on average will be making more money on unemployment than if they went back to work. So the restaurant industry is going to have a very tough time recovering from what's going on right now, and that also gets to the crux of the thesis, and this is the valuation aspect of our argument. Despite unprecedented hurdles that Middleby is facing, go ahead, Oliver.
Well, I just want to highlight that because this is a really interesting concept, Eiad. What you're saying is that, and I think we have a chart from the report that shows this, because it stuck out in my mind as well. The assistance based on the government paychecks relative to what some people were making in the restaurant industry, you're saying is actually better than what they were doing hourly, so they're not going to go back to work. But so that's a problem because then the restaurants won't actually have a workforce? Is that what I'm understanding here?
That's exactly what we're saying. I mean, basically, while the additional money is undoubtedly going to help people meet their most basic needs, we think it's going to actually, we think it's going to end up serving to hinder near-term growth. As many of these hourly wage individuals are currently, incentivized to not go back to work. What's that mean for the restaurant business? Basically that, they'll depend on hourly wage employees. Those restaurants that do, they're probably not going to be able to staff their locations appropriately. And that inadequately staffed restaurants may have to reduce hours of operation, limit menu items and offerings, and or take a host of other, growth prohibitive actions to operate under staff. Now, this is already an industry under incredible pressure, and this brings me back to, the valuation aspect of our thesis, and that is that the sell side is projecting a V-shaped recovery in the restaurant business. It's just simply not going to materialize for a plethora of reasons pointed out in our report, which is up on our website. But, we don't think that the restaurant industry is going to participate given the damage already done, and I haven't even gotten, scratched the surface here. But moreover, even
your report's really extensive.
Oliver, even if the restaurant demand does see a V-shaped recovery, Middleby still won't participate in it because as restaurants delay CapEx, they grapple with heavier debt loads and lost revenue, and used equipment sales eat into revenue. It's going to be near impossible for this company to meet the V-shaped recovery that the consensus does expect.
Okay, so Eiad, a few things here. One, I just want to clarify the nature of the paychecks outweighing what they would have made. I mean, isn't that still going to be helpful to the economy, though? And people then, let's say I don't go back to work because I'm okay on my temporary paycheck, then hasn't there been enough unemployment? Well, somebody's going to take that restaurant job?
Yeah, well, it may help the not if they're getting paid with these unemployment benefits, and that's what we're saying. But look, for a company, for a restaurant, and they're all going to be competing to bring their staff back on, right? At a time where their staff is probably making more than they have been previously. But how then do you restaff? Well, you may have to pay a premium to properly staff your restaurant. So in order to be appropriately staffed, these operators may have to pay an hourly premium and for people to come back to work immediately. And then in the near term, this would weigh heavily on restaurant profitability at a time where this industry is in dire straits. Now, Middleby is in the eye of the storm because Middleby serves this space, and there are going to be knock-on effects from restaurants going out of business, and specifically, we expect used equipment to hit the market. That's going to eat tremendously into Middleby's sales and demand for its products. So again, in the off chance, which is completely improbable, that the restaurant business does stage a V-shaped recovery, Middleby is not going to participate in that like Wall Street expects at current. This is one of the most dislocated securities that we've identified. It is a tremendous short opportunity here.
Okay, now Eiad, one of the other important things here, because you started off with debt, and I just want to point out that I looked at some of these numbers, and again, relative to their peers, according to the Bloomberg data I pulled up, the debt situation is very unique. Net debt at almost $2 billion. Relative to equity, it's pretty high to their peers too. So that's the debt side, and your point is on the other side for the actual cash flow and their growth already, they were struggling to begin with. Can you walk me through how this company was doing before the crisis?
Sure. Yeah, so absolutely. So Middleby, it's always been an acquisitive company. So since 2001, the company's made more than 90 acquisitions. It's incredible. But the M&A activity really started to pick up dramatically around 2013. And interestingly, that coincided with peak organic growth. Now, Oliver, we've seen this playbook before. We have made a specialty of identifying companies that use aggressive acquisition accounting to mask deteriorating fundamentals, and Middleby has done just that. So, what we see in these types of situations, and again, you can look at our body of research that we published in the past, and you'll see that we've made a specialty of identifying these broken roll-ups, such as LKQ or Chicago Bridge and Iron. But basically, when you see that the companies being acquired become ever lower in quality, the companies paying a larger and larger premium for these lower quality companies, it becomes clear that this company is continuing to do this to obfuscate deteriorating and negative organic growth, and we think that this is a classic red flag of desperation. So.
Okay.
And it's not just that. When you look at the pro forma growth in 2019, it's negative. In other words, revenue from the recent targets have deteriorated after they were acquired. And so as demand disappears, for the reasons I was talking about just a little while ago, and leverage hovers near all-time highs, we think that this debt-fueled roll-up strategy is going to implode. And listen, when a company's profitability declines tremendously, its leverage shoots higher. So we're expecting this company to be, the most levered it's been in recent history. It's going to be dealing with, it's going to be struggling for a long time to manage itself out of these previous excesses.
Hey, Eiad, we're out of time, but just real quickly, it's already dropped 55% this year. Do you have a price target or a valuation that makes sense? Just real fast.
Yeah, we think it's likely to get cut in half again.